If we look at where students typically struggle in accounting, the failure point is almost always the year-end adjustments. Over the next few minutes, we are going to build a repeatable framework to process the 4 adjustments that appear most often on your exams. This timeline represents the matching concept, or accrual basis. It is the rule that locks your financial statements into a specific 12-month window. Under this rule, a business can only record activities that occur exclusively within these 12 blocks. This applies regardless of when physical cash enters or leaves the bank account. Memorizing journal entries leads to mistakes. Understanding the logic of this 12-month boundary provides a clear path to balanced statements. First, consider the accrued expense. This is a cost the business incurred this year, like rent for December, that has not been paid yet. Look at the timeline. You've used the building for the full year, but because the payment hasn't happened, that 12th block is still empty in your records. To fix this, we increase the total expense on the income statement. This ensures the record reflects our actual usage for the year. Then, on the balance sheet, we record that unpaid amount as a current liability under trade and other payables. Note that we do not change the bank account balance here because the cash hasn't actually moved. Recording accrued expenses ensures the company doesn't hide its obligations, giving a more accurate view of its true financial position. Next is the prepaid expense. This happens when you pay upfront for a service you haven't used yet, like paying for 13 months of insurance. On our timeline, we have a problem. 13 months of costs are trying to sit inside a 12-month window. We adjust the income statement by decreasing the total expense, removing the portion that belongs to next year. We then move that portion to the balance sheet as a current asset under trade and other receivables. This early payment is treated as an asset because the business now owns a benefit it will receive in the future. The third adjustment is income received in advance. This is cash received from a client for work you haven't performed yet. Even if the cash is in the bank, the service hasn't been delivered. That money hasn't been earned within this financial year. To reflect this, we decrease the total income on the income statement, pushing that unearned amount outside our current 12-month boundary. On the balance sheet, we track that money as a current liability under trade and other payables. This is a liability because the business is now obligated to either finish the work or provide a refund. Finally, we have accrued income. This is when the business completes work for a client, but the final payment hasn't arrived. The effort was made and the product was delivered, but the cash record for the year shows 0. On the income statement, we increase the total income. We do this because the work was completed within this specific year. On the balance sheet, we record the money owed to the business as a current asset under trade and other receivables. Documenting this ensures that the income statement reflects the total value the business actually produced during the period. Applying these 4 adjustments provides a consistent system for your year-end process. When the adjustments are complete, the worksheet aligns perfectly with the 12-month timeline. Before you begin working on a trial balance, draw a 12-month timeline at the top of your page. For every adjustment you see, ask yourself, does this specific amount belong to this year? These procedures exist for one reason: to ensure every figure we report stays within its specific 12-month window.